Profit margin. Profit margin can be defined as the amount of profit that a business keeps. It shows how many kobo a business keeps for every naira of sales. This is so important to both entrepreneurs and investors. In fact, lenders and serious investors will consider this as part of the criteria for giving a business money. It is also used by lenders, bankers, investors to determine the financial health of a company. As an investor or an entrepreneur, you must consider this before starting a business or investing in one. Profit margin represents the percentage of sales that will be turned to profit. Types of profit margin. 1. Gross profit. Gross profit is calculated by net sales minus COGS divided by net sales percentage, where net sales is gross profit minus discounts and returns and allowances. COGS is cost of goods and services, that is everything involved in producing what the company does. Gross sales is total sales made within a period. 2. Operating margin. Operating margin is calculated by net sales minus COGS minus SGA, all divided by net sales percentage, where SGA is selling, general administration and advertisement. This includes such things like rent, advertising, research and development, etc. Most people don't calculate COGS, that is labor, raw materials, salaries, etc. Everything involved in producing the goods and services they sell. Or SGA, office rent, warehouse rent, advertising, internet connection, research and development, etc. They don't consider these things when calculating the cost of running their business, and it causes all sorts of problems for them, and they don't understand why they can't make a profit. You can't run or plan a successful business without an accountant to help you understand these numbers. Please note, I'm not a qualified accountant, so I may not be correct about some of these definitions and numbers, but I hope you get the idea and you begin to see the reason why you should get an accountant. Number 3, net profit, aka bottom line, aka net income. This is what is left after everything else. This is how profitable a company is. Net profit is calculated by net income divided by net sales, where net income is gotten by net sales minus COGS minus other expenses minus interest minus taxes. These numbers will show how much profit there is, how much is left for the investors and shareholders. Let's look at some of these things, the profit margins with numbers to make more sense. Let's take, for instance, let's assume we have total sales, gross sales of 1,200. We give 10% discount. We add 80 returns of 80. Our COGS is 350 and our SGA is 320. Hope you remember what all those things mean. You can always go back to look at them. Net sales is 1,002 minus 120 plus 80. That is gross sales minus discount of 10%, 1,200 minus returns of 80. So our net sales is 1,000 rather, sorry. Gross profit margin is then calculated by 1,000 minus 350 divided by 1,000. Our gross profit here in this our hypothetical business is 65%. Second, operating margin, we calculate that by net sales minus COGS minus SGA divided by net sales. In this case, that's 1,000 minus 350 minus 320 divided by 1,000. It gives us a operating profit margin of 33%. Now, to calculate profit margin bottom line, let's make further assumptions. Let's assume taxes is 100 and interest is 80, and we add other expenses of 120. To get this, we say net sales minus COGS minus SGA minus taxes minus expenses minus I've forgotten the last one now, but so the numbers will be 1000 minus 350 plus 320 plus 100 minus 100 minus 80 minus 120, all divided by net sales of 1000, and the profit margin here is going to be 3%. How do you get these numbers? You get these numbers by keeping accurate record and detailed records. Best thing you can do, get an accountant and a bookkeeper. If your business does not have accurate books, how can you know the profit margins? How can you know the gross margins? How can you know if you are profitable or not? Accurate books is a panacea for not losing money. It is required to build a business. What is a good profit margin? It depends on you and your business. I'm not a professional, so I won't talk more about this. How do you increase your profit margin? You can increase your profit margin by doing one of the following things: reduce cost, sell to more people, increase the number of customers you sell to, increase the number of times each customer buys from you, and 4, increase your price. To make this clearer, let's use some numbers. Let's assume we double our sales and keep everything else constant. That is, we double the net sales, but we keep the COGS, cost of doing goods and services, the SGA, we can't keep taxes. Let's assume we double taxes, the interest and other expenses, we keep everything else constant. What happens? Now we have net sales of 2000 minus 350 minus 320 minus 200, the taxes double, minus 80 minus 120 divided by 2000. This gives us a profit margin of 46.5. Wow, just doubling the sales more than doubles the profit margin. To increase the profitability of your business, you should do any of these 4 things. 1, reduce cost. 2, increase the number of people who buy from you, or that is, increasing the number of people you sell to. 3, increase the number of times each person buys from you. 4, increase your price. If you want to increase your profit exponentially, do all 4 at the same time. Easier said than done, but it's very doable. You can increase your profitability further by using leverage of positions. That's cash, debts, contracts, and equity. Remember, thank you for listening. Do you find this useful? Please share with family and friends. Do you have any questions, suggestions, or comments? Please send me a DM. I'll be grateful and happy to reply, or leave a comment and I'll reply to you. Once more, thanks for listening. Have a great day. Ciao.